Good morning. Welcome to the 2025 Sunrise Multifamily Summit. I'm Heather Schechter, Chief Strategy Officer at Sunrise Management and Consulting. We're a property management, development, and investment company based in Latham, New York. Since 1998, Sunrise has worked with owners and investors to create properties where people feel at home. When residents feel connected to where they live, both our residents and our businesses thrive. And the same is true across our communities. Collaboration helps all of us in the industry grow stronger together. We previously hosted this event in 2019 after its debut in 2018. And then we planned it for 2020. And like many things in 2020, our best plans had to wait. So here we are in 2025 with our next Sunrise Multifamily Summit. I want to thank our sponsors, BBL, Broadview Federal Credit Union, Howard Hanna Real Estate Services, the Richer team at Hanna Commercial Real Estate, and Sunrise Management Consulting. Your partnership makes this program possible. This morning's agenda starts with a keynote conversation with Hugh Johnson of Hugh Johnson Economics and Jesse Holland of Sunrise Management Consulting. They're going to discuss where we are in the economic cycle, how interest rates, immigration policy, and tariffs are shaping the market, and what it all means for housing and investment. A special thank you to Hugh Johnson for joining us today and for preparing a detailed report that I'll be sending out after the summit. Following that, we're going to shift to a panel discussion moderated by Mike DeMasi of the Albany Business Review. Thank you, Mike. It's going to feature Jesse Holland of Sunrise Management Consulting, Steve Obermayer of BBL, Jessica Richer of the Richer team at Hanna Commercial Real Estate, and Brian Sheldrick of Broadview Federal Credit Union. You'll find the agenda and the speaker bios on your program so you can learn more about today's participants. Thank you to all of you for the difference that you're making by being here. $20 from every ticket sold is being donated directly to the Regional Food Bank. This support matters now more than ever. The food bank serves families in 23 counties across eastern New York, from the lower Hudson Valley to the Canadian border, and demand has reached record levels. According to the organization, 1 in 8 people in our region is now food insecure. And with SNAP benefits expected to be cut off this weekend, the food bank anticipates an even greater strain on its resources. To keep the impact going, scan the QR codes on your table tent to learn more, volunteer, or donate to the Regional Food Bank. Now let's get started with our keynote conversation.
Good morning, everyone.
Good morning.
So, first, Hugh, let me thank you tremendously for being here. You need no introduction in the capital region, so I'm not even going to try. But you have taken a complicated topic of economics and the grand economy and made it so all of us in the business community can understand how it impacts us and really simplified it. So thank you for that.
You're welcome.
So we're gonna grab your mic there. So we're gonna. You don't talk to Hugh Johnson without talking about cycles. That has always been your sort of trademark place to start. So, Hugh, where are we in the economic cycle right now?
I wish I knew.
And why does that matter?
I wish I knew. It changes every day, as everybody knows. Anyway, thank you very much for Jesse for asking me to come and join everybody here today and talk about something that it's very hard to stay on top of these days, particularly because right now, as everybody knows or understands, what makes our life very difficult is the fact that we don't get any numbers anymore. We don't get any numbers out of Washington, so to some extent you're flying blind or you're going a little bit blind and trying to make up the numbers as we go along. There are some sources of good information that are useful, but it's not as quite precise as it was when the government was open. You probably heard Chairman Powell of the Federal Reserve say those same things yesterday. It's great to be here. As one of my good friends from Albany, from SUNY Albany, used to say to me, Hugh usually tells a joke and then gives a forecast. He said the whole problem is you can never tell which is the joke and which is the forecast. I have only one story. I have a friend of mine who was a woman who was diagnosed by her doctor as being terminally ill and told that she only had 6 months to live. And she said, well, doc, what should I do? And he said, you should marry an economist and move to Iowa. And she asked him, she said, well, will that cure my illness? He said, no, but it'll be the longest 6 months of your life. I certainly hope that this isn't the longest. How much time do we have? 30 minutes of your life. Where are we in the cycle? I've been looking at cycles, studying cycles since, all of the cycles since 1890. Cycles which consist of an economic cycle, followed by a stock market cycle, followed by an inflation and interest rate cycle. You ask a great question, where are we in the current cycle? I've tried to, it is a question that I get asked very regularly. It is a question which I've spent a lot of my adult life, boring as it may sound, developing a methodology to try to answer a question just like that. Without spending a whole lot of time going through it, the methodology is really very simple and straightforward, and it consists of two primary steps. The first step is to identify important trends right now, trends that are unfolding in the financial markets. And the reason I do that is because, as I mentioned, the cycles consist of three parts: a stock market cycle, followed by an economic cycle, followed by an inflation and interest rate cycle. And I've learned over the years that the financial markets perform in very specific ways at the beginning, the middle, and the end of the cycle. And so by identifying trends in the financial markets, you can tell or identify where you might be in the current cycle, and where you might be in the current cycle, and as a result of that, making investment decisions, good investment decisions becomes not easy, but at least a little bit easier. So that's really the first step. The second step is to identify what's going on, the trends in important monetary and economic variables. And the purpose of the second step is to try to decide or determine if the investors are being rational. Are investors getting it right? Are investors collectively rational? Are the markets performing in a way that's consistent with a rational forecast for the economy, earnings, inflation, and interest rates? So there are those two steps. You want me to give you
So the most exuberant guys in the industry, the real estate brokers, are on the edge of their seat. What's the answer? Where are we in the cycle?
I'm going to try to give you a brief answer. Trying to give you a brief answer is not easy. But let me just, first of all, just sort of summarize what the performance of the financial markets has been. And I think some of you know this or watch it carefully and do know this, but it's important. And the first thing is, of course, the equity markets have been performing well. The stock market is measured by the S&P 500 is up 13% this year. That's good news. Stock market sectors, the so-called bull market sectors, the more volatile, the higher risk sectors of the market are outperforming the safer sectors of the market. So things like technology, consumer discretionary stocks, industrial stocks, which tend to be more risky or are more economically sensitive, are outperforming the safer stocks such as utilities and consumer staple stocks. Those are the stocks that investors migrate to when they're very worried about the economy. They're not doing that. Sectors are the economically sensitive sectors of the market are outperforming the so-called safer sectors. Growth stocks are outperforming value stocks. The difference between, I know I'm taking a lot of time there, Jesse, and I'm going to try to cut it down. The difference between the yield on a investment-grade corporate bond, or for that matter, even a below investment-grade corporate bond, the difference between the yields on corporate bonds and 10-year treasuries or treasuries has narrowed, and investors only do that. They only take that level of risk when they're optimistic about what's going to happen to the economy going forward. And so that's a very positive. Another a positive sign, which people don't follow and don't quite understand, including myself, but don't quite understand, and that's the so-called, and I apologize for being a little bit technical, the yield curve. The yield curve has steepened. The Federal Reserve Bank of New York quantifies the probability of a recession starting in 12 months based on that yield curve. And that probability has declined from 50%, which is where it was a year ago, 50% probability of a recession, down to roughly about 20%. So the performance of the financial markets is fairly clear. Investors collectively are saying to us that prospects for the economy are good, or that the economy is going to continue to expand through 2025 and also 2026. And your question has to be, well, is that rational? Is that a rational forecast that investors are giving us? My answer to that question is yes, and I'm going to try to be really brief on what should be a long answer, but and very briefly, the answer is yes. Primarily, the answer is yes, and I'm going to try to summarize this in a way that makes any sense. Is that the Federal Reserve, of course, in 2020 and 21, increased their ownership of securities, treasuries, and mortgage-backed securities. And they did that by buying treasuries and mortgage-backed securities from everybody you can think of. Obviously, insurance companies, banks, hedge funds, even individuals. And they did that by, they actually went to those banks, hedge funds, individuals, and they paid for them, which increased the money supply by over $6 trillion. As a result of that, of course, the government the Federal Reserve had helped the economy survive or recover from the decline of 30% in a 30% gross domestic product decline contraction. That was the biggest contraction in our history. And so they did a good job of that in 2020 and 21. And then, of course, unfortunately, inflation also came along with the increase in the money supply, just as you might expect. Predictably, and the inflation rate increased at a 9% annual rate. So they turned around and they started to reduce their ownership of treasuries and mortgage-backed securities to try to reduce the rate of inflation, and it worked. What was really fascinating, and this is really fascinating to me, again, I apologize for taking so much time.
I'm going to ask you the big question
It's a great phenomena, and that is, even though they increased the money supply, the economy continued to expand. And the reason why the economy continues to expand, as my good friend Professor Goldberg at SUNY said to me, look, Johnson, the money supply went down, it contracted, but the economy kept continuing to expand. Why was that the case? And he used to look at me and he used to say, it's velocity, Johnson, wake up, it's velocity, which meant that although the money supply did contract or declined, the turnover of the money supply was very rapid, and it was very rapid because investors were very worried about inflation. So you're worried about prices of groceries going up the next day. You go out and you spend today, and as a result of that, we got a lot of spending based on even a small amount of money growth. That's a little bit changed now, and it's changed for the better. The money supply, the Federal Reserve has done a magnificent job of managing this. I can't begin to tell you how good a job they've done, because they've done such a poor job so many times in the past. Now they've done a really good job. And one of the big things, the big factors which you should think about, you won't think about, but you should think about, and that's liquidity conditions are now turning positive. That means there's now enough money, growth, because of what the Federal Reserve is doing, to drive both the economy and the financial markets. Under conditions when liquidity conditions are positive, the stock market has increased at a 16.2% annual rate. When they're negative, it's increased at a 2% annual rate. So the fact that liquidity conditions are positive is not only good for the stock market, but good for the economy. What does it mean for the economy? Is that what you're going to ask me?
No, but there are some forces.
Anyway, I've talked a long time,
Yep.
But I've given you a positive sign. I'm not turning this in any way to try. I'm not trying to be a nice guy. I'm not trying to be friendly. I'm not trying to do any of that. I'm just telling you the numbers as they currently exist.
Okay, so we do have some powerful forces acting on everything right now. Interest rates, immigration policy, tariffs. All of these shape the economy.
Yeah.
How do we think about, or how should we think about those factors?
Let's think about interest rates. First of all, the Federal Reserve, as you know, reduced short-term interest rates yesterday. They're faced with a very difficult issue. First of all, we're starting to see some weakness, softness in the labor markets. And under those conditions, you want to reduce short-term interest rates and try to stimulate the economy and help the labor markets along. And they're thinking about that. But at the same time, we're starting to get a nudge higher in part because of tariffs, only in part because of tariffs, a nudge higher in the rate of inflation. And under those conditions, you really don't want to reduce short-term interest rates or stimulate the economy because it might lead to higher inflation, especially when inflation at around the 3% level, 2.7 to 3%, is well above the target of 2% that the Federal Reserve's target of 2%. The Federal Reserve has opted to emphasize or worry more about the decline in labor market conditions, which is what they should, and as a result, they reduced short-term interest rates yesterday. The question is, will they reduce short-term interest rates again? My guess is, and this is not what is a general agreement because it started to change yesterday. My guess is the Federal Reserve will meet in December and they will reduce interest rates again in December. They will reduce interest rates again, quarter of a point in 2026. We'll also reduce interest rates one time in 2027. What that implies that long-term interest rates, the yield on a 10-year Treasury is now 4.05%, is going to come down as the Federal Reserve reduces short-term interest rates once in December, once in 2026, once in 2027. How much will it come down? It'll come down from its current level, as I mentioned, 4.04%. In my judgment, in the fourth quarter of 2026, it'll be at 3.88%. And in the fourth quarter of 2027, it'll be down as far as 3.75%. So the Federal Reserve policy carries with it positive implications for longer-term interest rates. And that's really good news. What's this mean for the stock market? What it means for the stock market is you have a combination here of the Federal Reserve reducing short-term interest rates, longer-term interest rates coming down. And one of the things that's as positive as you can possibly get is the earnings numbers that we're looking at for 2025, the remainder, as well as 2026 and 2027, are astoundingly good, astoundingly strong. And we're talking, when I say astoundingly strong, we're talking about 14% growth rate in S&P 500 earnings in 2026, and about 13% in 2027. If you're an owner of stocks and you're asking yourself, what do I need for the stock market to do well? Well, strong earnings and declining interest rates is a pretty darn good combination. The only thing you have to worry about is that in many pockets, there's a little bit of overvaluation now, so be very careful. You're not getting me to talk about my favorite subject, which is manias. And it's obvious that we've moved from something which we might call rational. Do I have just a second?
Yep.
Move from something that is rational, which is the performance of the markets has been relatively rational, and it's starting to move towards something that is a little bit less than rational. It's starting to move from what I call the investment stage to the stage of speculation. When investors borrow money to buy stocks, some stocks, Bitcoin, NVIDIA. I own NVIDIA, so I'm going to tell you that for full disclosure. But at any rate, it's starting to move to investors buying stocks, borrowing money to buy stocks at prices that are a little bit pricey or overvalued, with the hope or the dream or the fantasy that they're going to become even more overvalued. That's called the stage of speculation. The stage of speculation, which I think is going on with regard to individual stocks or sectors of the market, is replaced by or followed by the period of a stage of distress. In distress, some investors that have become speculators who have borrowed money to buy stocks at prices that are overvalued begin to have difficulty making their debt service payments. And some of the lenders who finance the speculation start to back away from the markets, and prices start to give ground. And I think you're going to see that, and you're starting to see that, a little bit of that right now in some of the stocks.
So how do you think immigration and tariffs are going to affect us? The two areas that the real estate community
There's so
is
much we can
sensitive to.
talk about. The one thing is, I've sort of given you a pretty positive picture, and I think it's an accurate picture, but it's not as though there aren't significant risks. And the risks are manifold. Probably, I think, at the top of the risk is deportations and immigration policy. What we've seen is a very, very, very significant decline in the number of, first of all, foreigners in this country, but secondly, and most importantly, foreigners that are part of the labor force. The U.S. economy is a function of the growth of the labor force, employment, and productivity. Productivity was poor in the first quarter, good in the second quarter. We'll see what it does when AI starts to kick in more. But nevertheless, productivity was good, but we're seeing a decline in the size of the labor force, and that's largely because of deportations and immigration policy, which is extremely foolish. But nevertheless, it is showing up in some softness in the economic conditions or the labor markets, which is what I mentioned before. That is a significant concern for the labor markets. So that's one very big risk. The second risk is we've got and I'm going to just hit this really quickly. Because of the one big beautiful, well, it's actually called the Recovery Act now, the one big beautiful bill, we have a significant increase in the size of the federal deficit over the next 10 years of $3.1 trillion. Now, if you do the numbers and you spend some time looking at the collections from the tariffs that we've imposed so far, you will see that those numbers come in at about $30 billion, $300 billion a year, which will cover the increase in the deficits for the next 10 years, assuming that they don't find something else to do with the money, in other words, spend it in different ways. That's a really, the connection between tariffs and the size of the deficits, largely a function of reflecting the extension of the 2017 tax cuts beyond 2025. That is a very significant problem, and I think one that we're going to have to deal with. It might require us to hike interest rates at some point in time in order to attract capital from foreign investors, because we may need their money in order to finance these deficits. I hope that's clear, but that's a very significant problem.
Excellent. So let me interrupt you. I'm going to steal one of your jokes. It's like when doing a projection, I will tell you how high it's going to go or when it's going to be there, but not both. So
yeah, if you give a number, don't give a date.
Don't give a date. So we're gonna press you for both. Actually, I've learned from you that it's not the number that they predict; it's what the corrections are over time. Are they correcting above or below, and that tells you the trend to go to. Yeah. So, for an outlook on the GDP, inflation, the labor market, how as investors in the multifamily arena in real estate, what do you think we should be looking for?
Well, I've crunched those numbers. I don't even make sense of them, and I'm sure you all understand them, and can make sense of them. But I think when you look at 2026 and 27, price levels on the residential area, price levels are going to be fairly flat, although activity flat. Not completely flat, but pretty close to flat compared to where we've been. Activity, for some strange reason, is going to be very high. Or let's put it this way: activity is going to be really good. You're going to be doing a lot of business, but unfortunately, the prices of what you're selling. The other thing is, which I want to mention, and I did all these numbers in the last couple of weeks, and I wish I could remember them off the top of my head. Personal income, because of the economy is going to continue to grow, 1.8% this year, 1.8% and then 2% in 2027. Personal income will be fine because the Federal Reserve will be reducing interest rates, as I mentioned before, both in December and next year. And because longer-term interest rates will be coming down. I actually have mortgage rates, and I think I got the number right, at 6.18% yesterday, 30-year mortgages, coming down below 6% in 2026 and 2027. So that's a big positive. As I mentioned, prices being fairly stable, mortgage rates coming down, personal income going up. You can just imagine what that's going to do to affordability. And the answer is just as you suspect. Affordability will get better. So you'll be more active, but you'll be dealing with, I think, you'll be dealing with prices which may give a little bit of ground, but are going to be are fairly stable in 26 and 27. Those are my numbers, and I know you are very skeptical and probably look much more carefully at these algorithms, but there you are. And we can talk about the economy as a whole too. But
Sure. Talk a little about the economy.
well, the economy as a whole, even though it's in the process, as labor market conditions are a little bit soft, and we aren't getting the numbers, so it's really hard to tell you. But I think that the consensus forecast is that the economy is going to slow to about a 1.8% level from a little bit above 2% in 2024. So 2024, 2%, then down to 1.8, and then start to not accelerate, but pick up a little bit as we go into 2027. Positive growth for the U.S. economy, and that stands to reason when you're reducing short-term interest rates and you have corporate profits or the corporate sector doing as well as it's doing. So good numbers for gross domestic product. Inflation is around that 2.7. It's going to nudge its way higher because of tariffs. You're starting to see it already in the numbers. Not a lot, but you're seeing enough of it that we're going to have some upward pressure on inflation. Not enough so that it's going to cause the Federal Reserve to, I don't think, and not enough so that it's going to cause the Federal Reserve to stop reducing short-term interest rates. It means the Federal Reserve is going to continue to have its focus primarily on labor market conditions. What am I missing? The unemployment rate. The only thing I could add is the unemployment rate currently around 4.3%, up a little bit in 2026, up to 4.4%, and then back down to around 4.3, maybe a little bit less as we move into 2027. But the unemployment rate is likely to be reasonably steady, maybe give a little bit ground as we get into 2027. So we've got those are the kinds of most important variables. And again, as I mentioned, long-term interest rates coming down, stock prices maybe move a little bit higher. You won't make a lot of money in the stock market because of current valuation problems. And also, you got to be really careful when you get into those speculative parts of the market, such as the AI stocks. I mean, be really careful there, because they can pull the rug out from under you in a very quick way, and it can contaminate the rest of the market. I'm worried. I'm genuinely worried about that. I'm also worried about the single biggest worry that anybody can have if you've looked at 2020 or 1929 or looked at all the major crises in our history, and you got to look at all of them. And not the book 1929, but you got to look at all of them. And you will see the number one problem that we potentially could face, which was faced in 1929 and also faced in 2007, is credit. Believe me, the growth of credit is starting to get a little bit. You have some bankruptcies which are announced in September. It impacted some of the regional banks. You saw a very sharp decline in the stock market generally, but particularly the bank stocks. You got to be worried about credit. And Professor Kindleberger, who those of you who have heard me speak before know I absolutely adore, he wrote Manias, Panics, and Crashes, the very best book ever written on the financial markets. It's really worth getting. And but Professor Kindleberger will tell you that the Minsky model. I know this is it doesn't sit with a lot of you. The Minsky model is really important, and Kindleberger picked up on it. And the Minsky model is all about the credit conditions that existed in 1929, but also have existed a lot during crises since then. So you got to be a little bit worried about credit conditions. Watch for, we got a warning about a week ago on what can happen to the markets when there's an announcement of a bankruptcy and it's going to affect or impact the financial condition of banks. I hope that was clear.
Excellent. So
clear.
Thank you for all of this input and to discuss how this is going to affect our industry. We're going to switch to our panel discussion and get some local knowledge and into the nitty-gritty. So thank you so much for joining us this morning, and always interesting.
For those who want to dig deeper, I will be sending out Hugh's 6-page analysis and you can all read all the numbers. It was fascinating to watch the audience during this and see who was really absorbing and who was going a little bit over your head. But we have a lot of people from the banking industry here. I know you're very involved in all of this, and also investors. So right now I want to invite the panelists up. We have Jesse Holland of Sunrise Management Consulting, Steve Obermayer of BBL, Jessica Richer of the Richer team at Hanna Commercial Real Estate, and Brian Sheldrick of Broadview Federal Credit Union. This is moderated by Mike DeMasi of the Albany Business Review, and you have the bios right on the handout at your seat. So thank you so much.
Thank you, Heather. Can everyone hear me? Excellent. Well, thank you all for being here. Even though this is not a business review event, it feels that way because of the terrific mix of familiar and new faces and a very knowledgeable panel. And thank you, Hugh. I always enjoy hearing from you and always appreciate your humor and humility. So I've got a list of questions that obviously I'm going to be asking the panel here. We have some questions that were submitted by some of you, and there will be an opportunity as we go along to take questions from the audience. Just please raise your hand. Somebody will come by with a microphone. I just ask, please, make it a question, not a speech. And we can continue very efficiently that way. So let's just start off with kind of a basic question. What trends are you currently seeing with commercial real estate in the capital region? Jessica, could you go first?
Sure. Thank you, Michael, and good morning, everyone. We're seeing a lot of interesting trends in commercial real estate. A couple years ago, industrial was incredibly hot. Everybody was buying warehouses. That slowed down. Multifamily, though, is still extremely advantageous. We have a lot of people that want to buy multifamily, invest in multifamily. And if you look at the articles that you're seeing specifically in your newspaper, the prices are outrageous. And that's one of the biggest trends I'm seeing. And the office sector, things have slowed down. We have millions of square feet that are empty in Albany, in towns, even in the suburbs. So that really hasn't changed over time, although we are seeing a lot of leasing that is happening, small leases and large leases. So people are moving back to the offices.
Brian, what's your perspective from Broadview?
From our side, what we've seen is some of the, I guess, X factor and where people think rates are. A lot of people are holding off on doing things, purchasing, starting construction, things like that. I think some clarity in where rates are, even though we feel like they may move down a little bit more, has allowed, I think, some of the doors to open. We've been very busy on the refinance side, less on the purchase side. Outside of warehouse, we have seen a lot of warehouse purchase. With regards to people leveraging their assets to buy their next set of assets. So there was kind of a slowdown of that, and now we're seeing it pick up dramatically because I think there's some clarity. People feel like, all right, we know we're not know exactly where we're going to be, but we have a better sense of where we're going to be, so they can start actually working with their budgets.
Okay. Steve?
You know, it's pretty strong right now. And first of all, I want to thank everybody for coming today. Mingling out in the pre-function area, a lot of talent, a lot of brain power here. And, to solve this affordable housing problem, I think we have enough brains and talent in this room just to do that. And, if we were our own company, would be very, very, powerful. I could be like the chief marketing in charge of public relations, to lead such a company. But, and the other thing I think, today, maybe we should go to a different format. Like Price is Right, when Mike asks a question, I can look out to the audience, people can give me the answers. But right now it's very strong. Actually, BBL's backlog is the strongest it's been in the company's history. And I always view us as a leading economic indicator because whenever there is a downturn, the first thing that goes is CapEx commitments. And right now, there's a lot of, the larger projects are going forward. We're working on several right now, whether they be BOCES or the Capitol Center expansion. A lot, healthcare continuously redefines itself, several big projects there. Also, large government administration projects, a lot at the county level. So it's very strong. What we worry about, we also have a real estate development portion of our business. And so we're users of construction services as well. And recently with the increase in construction costs, which has really been a pre-COVID phenomenon, and Hugh spoke about the cost of capital, it has been significantly higher, and it was a really steep increase. And it is difficult for the regional developer to put together a capital stack with a, with an adequate return on investment, along multiple industries. I agree with Jessica that industrial was very strong, but all these things have a cycle to it. I think what's unique about housing is that the demand is there, and as a society, we need to address that demand in an innovative way, because at the core, we need strong schools and we need strong neighborhoods.
Thanks. Jesse?
Well, I would describe multifamily as strong but challenging. There are certainly some headwinds that we deal with. The law changes in 2019 that were definitely anti-landlord, and that drum still beats. Although we've beaten back some of those legislative priorities or moderated them so that it doesn't really destroy the market. I think it's challenging from the operating expense side of things. Inflation and tariffs and shortages have all had an effect on what we're able to do, how well we can maintain the properties. And those are the headwinds. From the positive, we haven't built enough housing in the country or even in the capital region for, I would say, at least the last decade, that the demand has always been there. I'm a believer that the price side tends to push the multifamily rents faster than the shortage side, that money always needs a return, and therefore, if you make it more difficult for me to operate the property, if it costs me more to operate the property, the rents are going to have to go up. However, the only way to defeat the supply shortage is to create more supply. And unfortunately, we've had headwinds with that also with new wetlands rules and even code changes make it challenging. But
So let's stay with that topic of supply, because I think I've asked a variation of this question many times over the years, which is, are we ever going to reach a saturation point for multifamily in this region?
Yeah, I mean, from my standpoint, one of the things I think is interesting is in the 70s, the average person walking into a single-family home was 24 years old. Now it's 38. People are living longer. I've been wrong on the saturation thing, and in this market, I would tell you there is still plenty of opportunity because when we build here, even a large project like the one up the road, which is 300 units, doesn't make a dent. We see how quick the velocity of the lease-up is in this market, especially new. It's astounding how quickly these things are filling. The new amenities, the things like that people have gotten comfortable with, especially younger people who literally leave school, have college debt. They're either coming home or they're getting apartments. They're not looking at homes right now. It's just not affordable, and people are living longer, so they're not moving out of those starter homes like they used to in the back in the day. So we are very bullish on apartments. One of my mentors once told me from AIG that we asked a very detailed question, and his answer to me was, Brian, the population grows by 3% a year. Guess what? They got to live somewhere. So I'm very bullish in this market. We've seen we're involved in a bunch of newer projects, and I kind of watch lease velocity, and that has been tremendous. Even if you go from the B properties to the A properties to the brand-new properties, so.
But is that true across the geographic area as far as suburban versus urban?
We found, surprisingly, I thought there'd be a little bit more pushback in the urban area, right, like Albany. But those numbers are strong from the leasing and the per square foot numbers, numbers that I didn't think I would see, where your people are paying, over $2.50 a square foot for apartments. But the alternative is not there anymore, right? That person might be in a home.
Jesse, just for everyone's sake here, how many apartments does Sunrise own and or manage?
We're involved with about 1,200 units right now, and we have about 600 units in our pipeline for development at this point.
And obviously, you see no reason to kind of step on the brake.
Well, it takes so long to get something approved and built that you're really looking at anywhere from a big project might be 9 years from start to finish, maybe even longer. So when you look at how many units are getting delivered each year, it's usually less than 1,000 and really usually less than 600 across our entire market. So I think you can have a micro market that gets a little full or tough competition. We suffer wonderfully from a dislike of a long commute around here. Where I grew up in Westchester County, 45 minutes to an hour commute was like the baseline, and then you went up from there. And here, if you're driving more than 10, 15 minutes, it's a long commute. So people want to live right where they are. And so, when you look at, there's a lot of units in the pipeline. Many of them don't get built. It's not for the faint of heart. I started with a full head of hair. So it's tough to get a project from concept to completion.
So year to year, basically, supply is not keeping up with population growth.
Correct.
Okay. Jessica, Steve?
Yeah, Mike, there's a lot of different types of multifamily housing. You have to remember, we have student housing, we have senior housing, we have affordable housing, we have workforce housing, and we have market rate housing. So when you ask about saturation, there's a lot of niches that need to be filled. And people that develop housing, the first thing they're going to look at is a demographic study and an income study and see what's available, what's out there, and where the gaps are. So I don't see a saturation. I just see it being different levels of housing and filling those needs.
But is this kind of a flight to quality where like the older, smaller, less amenitized apartments are, they're losing their tenants because people can afford to move to nicer places or demanding nicer places?
I don't see that. I think that there's a niche for everybody.
Yeah, I would agree. People move up and down at different levels at different times in their lives. Their needs change. And I think that's more of an indicator, whether it's a location for a new job or, kids come in, kids go out. It's more of where their needs are at any one point in time.
I asked that question because 20 years ago, a hotel developer told me, we're not overbuilt, we're under-demolished in terms of, the age of a lot of the hotels at that time. Steve, you want to add to this?
Yeah, I think there could be saturation in certain submarkets, but as overall, generally, the demand is there, and this panel really believes that the way to solve that problem is through increased inventory, because most of the time projects are going to fill up through infill with people living in the community. And when that happens, there's more choices, for people, and other products become available for, the first-time renter. So I think, efforts into increasing inventory where the demand is should be the top priority. And I really agree with your points, relative, we have quite a bit of, demand in the senior sector right now. And a big thing there is affordability. And I think ultimately people want, a place that they can call home, that's safe and, meets with their, their certain, position in life.
Well, okay, let's stick with affordability because I feel like I'm regularly writing stories in which I say, yeah, the average rents or starting rents are $2,000 to $3,000 a month, which was unheard of 20 years ago for our area. So how concerned are you that rising rents are making market rate apartments unaffordable to an increasing number of people?
I'm going to jump in on that one. I would also say that $100 for a tank of gas was also, unbelievable. And you have to put it in context of the overall. Minimum wage is doubled, if not tripled, from 20 years ago. I don't know that incomes are going up as fast, but in the capital region, we've got some great economic drivers with Global Foundries, with SUNY and the chip fab, and all of these different industries where 20, 30 years ago we had state government and we were nice and level and flat, and now we've diversified greatly. So I think all of that has impacts on that.
I'm just curious, what's the highest rent you're currently aware of for a two-bedroom unit in this area?
I try not to quote individual rents because
We won't say which property it is, if you could just...
I think we've seen $3,500 a month, probably more.
Yeah, I know some penthouses around here that are over $4,000 a month.
And they're leased.
And they're actually the first ones at lease.
Yeah, but relatively speaking, it's a small percentage of the overall inventory. So you don't need to find a lot of tenants to fill those.
Right.
Jessica, what concerns do you have about affordability?
For my clients, it's a matter of getting financing to build or to buy.
Steve?
I do worry because, Hugh spoke about it. There was inflation of 9% post-COVID. The construction industry has really, bore the brunt of that. We've been, a couple of those years, we were averaging 7 to 10%. Right now, it's a little bit steady. But not only, do we have those levels of inflation, but it was very choppy and unpredictable. And, issues with supply chain as well, and the cost of capital. And if the cost of these projects are going up in that range, and it takes, 5 years to get a project started, the question becomes, can wages keep up with those increases? And there's a lack of choice, too, because there's a lot of barriers to first-time home buyers. So they're in the rental market, and I get back to how do we, have programs that can increase the inventory. I think we get back to that. I think that's the key.
Yeah, Mike, I would add this, what it costs to build, approvals, soft costs, all the things that developers have to go through. The rents have to be on new projects pretty significant just to make the numbers pencil.
Sure.
Those costs are at a level I've not seen, and again, the time element and things like that. So I also think, obviously, the market will dictate where rents go, but I do think that we're seeing projects that I would tell you need $2,000 a month just to get out of the ground, or it's not even a viable project.
So when you get approached for multifamily financing, how do you assess whether it's the right location and the right people to work with? How much is it gut instinct versus what the numbers say?
Well, I hope it's not gut instinct, because that would not be in my best interest. But I would tell you that we spend a lot of time. It's really sophistication of borrower. Do they have a track record in these areas? Location, obviously, is key. A lot of times we'll also get kind of reports on density and things like that. So we do a lot of homework in the backside to kind of double check our developer. I mean, we're very blessed to have very skilled and long-term developers here who will wait to do projects. It might be 7, 10, 12, 15 years because it's got to make sense. But that's one of the things we spend a lot of time really focusing on, the sponsor, their expertise, and it doesn't hurt if they have a big balance sheet.
Okay, so let me give you a scenario, hypothetical. So let's say I'm a first-time real estate developer trying to get a loan for a ground-up 20-unit apartment complex. am I going to be able to get financing?
It definitely would be possible. I think a lot of what we do is less clicking buttons like a residential place. I mean, you have to put it all the variables in a pot and kind of see if that makes sense. What I would say for a first-time person, I would be very conscious of my leverage going in. So I would over-leverage probably my first project with a lender, make them feel like you have a lot of capital and equity into that. So you might do a smaller project than you would have thought of, because I think that'll bring a comfort level that there's rooms to not be perfect, if that makes sense.
It does. Just for the record, I'm not thinking of leaving journalism, not yet. Jessica, what are some of the most common mistakes you see when working with inexperienced, whether it's realtors, commercial real estate investors, or developers?
So to me, it comes down to the team, Michael, okay? If you're going to do a project, no matter what it is in commercial real estate, but multifamily in particular, you need to have a team of people guiding you from start to finish. You need an experienced commercial realtor who knows the business. You need a banker who understands your finances, the project, and what you need. You need a good engineer, an architect. You need a CPA. And you need a good real estate attorney who understands that market. And if you have a team of people working with you, then you'll be okay. But if you just decide you want to do this and you don't have any guidance, good luck, because chances are you're going to hit a lot of stumbling blocks and spend a lot of money making mistakes that you probably wouldn't make if you had the right people helping you.
Jesse?
I'm going to jump in there because
Yeah.
the real estate brokers always forget the property managers on that team. We really, because we operate the property, we take the architect's pretty picture and say, hey, this doorway is not wide enough. I can't get furniture in. Or this fire hydrant's in the way, and it's going to cost me X dollars more to plow for the next 20 years. So putting that property manager on the team at the beginning really makes a huge impact from we get involved in the design of the buildings. I can't draw one, but I can tell you where we're going to have a problem. We can bring that history along and that expertise to make it operate properly, because I think it's a really important detail. Real estate is not a short-term investment. And that's what got us in trouble leading up to 2007, 2008. It's like, yeah, I can do a 20% IRR in 5 years. I'm in and out. Mm-hmm. And these are long-term, expensive projects. And you need to, in my opinion, you need to take a long-term view of it. I'm going to run this property for 20 years, 30 years, and I want to be profitable every single year. I like to tease Hugh and Dan Nolan is like, you have this balance theory. I'm going to win on some and lose on some. We got to win on all of them. We don't have that opportunity in real estate.
And if anyone's looking for a property manager, I'm sure Jesse would be happy to speak to you at the end of the program.
Well, Mike, I think I'll just add this part, especially on the apartment side, we don't really work, like the lease up is critical. Year 2, which is property management, completely focused, is where I will dig into numbers, because everything new leases. It's, can you keep those tenants? Are you doing the right thing as a property manager to keep those tenants?
Steve?
Mike, I would add builder to your list also.
I really set this up for them guys, okay?
The design build approach, which is a single source solution, is really an umbrella for the entire team. If people, I know people in this room know this, but if you take one thing away, the most important decision you ever make is putting your team together. And the advantage of having a design build at the onset is that, we can do estimates every step of the way, and that allows the owner to make good decisions. And we understand constructability and also the availability of materials, the availability of labor, the sequencing of events. So I think that design-build approach with a solid team will give people the most advantage. Mike's question was, what's the biggest mistake first-time people make? I think it might be over enthusiasm and get rich quick type of scenario. Real estate development, most people in this room know, is really grinding it out over a period of years. And unfortunately, we will have, a loss here or there, but they really got to be far and few between to be successful.
So when you're paying $2,000 plus per month for rent, what are some of the most important aspects and amenities that your target customer is seeking?
Well, I feel like, at least on the banking side, what we see is it's very critical. People have gotten used to, through COVID, certain amenities, right?
Yeah.
It's just the dynamic of what we've seen. And they're not really willing to bend in certain areas. But I do think it's tiered based on what you're willing to pay. If you're going to be in a Class A thing and it's a high rent area, well, you're going to want underground parking, right? Those kind of things. The gym is critical. I mean, I'm seeing dog wash stations in places, movie theaters, you name it. And then if there's some aspect where there's walkability, right, to your project, I think that's critical too. But I do think it's tiered really on the expectations of kind of what you're willing to pay on the rent side.
Jesse?
I would agree with all that, although I think any covered parking is certainly a positive. It doesn't have to be underground because that's really expensive, Steve tells me. But, it's also building that sense of community where you live, that there are community events, that there's opportunities, of common areas or, the patios with the barbecues or fire pits. Interesting, everybody builds a pool, but only about 7% of the residents actually use the pool, but people like hanging out on the deck. So
Is that true too of fitness rooms? Because I wonder how many
not as
tenants
much-
actually use them.
not as much on the fitness rooms. The fitness rooms, tend to be busy. And, we're looking at, bigger fitness rooms and I think that health craze has really continued, from COVID.
Is there anything new under the sun when it comes to amenities? Is there something on the horizon that you're like, here's the next one that people are going to want or expect?
It's always changing. But number one, as much as things change, there's always a consistency, no matter what's happening in the economy, the world, et cetera. Certain things are always the right thing to have. Excellent customer service, treating people with respect, having good policies and procedures, following the laws even as they're changing and doing the right thing. So maintaining your property as a long-term investment. We once had a conversation with one of our clients who was a short-term fund, and they're like, okay, we want to paint the decks around the pool. It's like, I think that's a bad idea because A, you're going to upset every other tenant who didn't get their deck painted. But now we're going to have to repaint them every 5, 6, 7 years. He said, that's okay, we won't be here then. And that's not the right attitude to come at this way.
One thing I will add, Mike, we have a project, a large $80 million project out west of here. The borrower actually bought the building next door was a restaurant, and he had restaurant connections. And he's using that restaurant because he owns that project and this one. And he bought it 7 years ago when he started his multifamily project as an amenity for his kind of higher end. So he brought in like a restaurant that would kind of cater to that. And we're also seeing a ton of mixed use where there's a restaurant on the bottom floor. That seems to be a very strong driver for people, even if they, to the point of whether they go or not, or decide not to go, that seems to be a very big driver with a lot of our developers.
Okay. I just want to remind everyone, if you have a question, please raise your hand and be happy to recognize you. What is, and this was one of the questions that was submitted, what is one non-negotiable that would cause any of you to walk away from a deal? What's the red line?
For me, it's having the right partners. If you can't trust your partners, if you're not building that trust, if you're not transparent, if your partner's not looking out for your best interests, not just their own, your project's doomed to fail.
Jessica?
Well, for us, it's usually starting out with the partners, but making sure the zoning is appropriate and we can get what we need from the municipality. And if we meet with the municipality and they don't want the project, it's dead.
Steve, is there something somebody has said or done that caused you to say, nope?
Yeah, I think if you have a solid team going forward, we're willing to go forward with the due diligence. And that's going to hash out a lot of these variables. The most important, I think, getting back to Brian, is, how that capital stack comes together, and is this project really feasible? If it's not zoned right, there are other mechanisms that we can try. There's plan unit developments and rezoning and other things that we can try to work on. But if you have the right team, the right capital behind it, and the market's there, we would be willing to proceed with the due diligence.
Okay. Brian?
Yeah, I mean, as a person whose job is just to give money and get it back, bankruptcy's not great, I gotta tell you that much. But outside of that, I mean, for us, I'll lean back into the capital stack. I've yet to see a construction project that comes in that the budget ends up exactly at the dollar that we started with. So there's wins and losses along the way. You want a borrower who's able to fix those problems if they arise, or contribute more in partnership with us. Sometimes we've done it, or it's $1 million overrun, okay, because of COVID or what's going on. We've tried to meet people in the middle, right? Both of us, I mean, we're partners in some capacity, but not really. But the reality is we want the success of the asset to be a partnership between both of us.
So speaking of due diligence and zoning, what makes one municipality better than another for seeking planning board or zoning board approval and getting construction permits? Notice I did not ask you which municipality. I'm just asking what makes one better than another.
Mike, we've thought about this a lot, and most of the municipalities, probably all of them, are very well intending, and the people on the board are civic leaders who put in a lot of effort and hard work. I think if you want to improve the entire process, is, one thing is, they only meet, once a month generally. And if there's an issue at the meeting that can be resolved in a few days or a week, you still got to wait another month. And so I think that's, one issue. And a lot of the folks, some of the, I think boards would benefit if they had more industry professionals as members of the board, whether they be realtors or attorneys or specifically, civil engineers. I think would really help. And I'm on a lot of boards, and generally our role is to support management and to be a resource and to provide oversight. The boards that we deal with virtually on a weekly basis are involved in the minute detail of every project, and all this we feel really elongates the process. So perhaps if boards have more of an oversight role and let the either the town designated engineer or their professional staff handle a lot of the details, I think could give us a more expedited process.
Jesse, you've been in front of various boards, including the town that we're sitting in right now.
So I think some are more generous with their ideas than others. And you have to manage that. You have to have an expectation of how generous they're going to be, and see where their concerns are and how you can fit that into your project and still come out with a project that you can afford to build and it will be worthwhile. There's many different ways to build something, how it's designed, how it's laid out, what their concerns are, how it interacts with the community. I would say of the projects we've done, I can definitively say there is no one right way. Unfortunately, sometimes with these boards, they want you to do multiple things that conflict with each other. You can't have a straight curvilinear road. It just doesn't work. So it's, sometimes it's showing them what their idea looks like, why it doesn't work, and then here's what would work, and just take some time to win them over.
Jessica, what's been your experience with your clients?
What we try to do is go in early with a concept and talk to people before we have anything that's final. And I think that helps. These guys really hit the nail on the head, though. You have to have the right partners, you have to have the right people on your team, and you have to understand what the municipality wants and what their process is, because every municipality is different.
Brian?
Well, I'm usually the eighth inning guy. I only get to hear about the complaints when it comes to these things, and then see the bills. So, yeah, I think we've seen a lot of our members who have multiple projects focus in certain submarkets where they seem to be more comfortable. Mm-hmm. They don't really want to be spread out all over the place. They seem to have a good working relationship with one or two municipalities, and they feel like they understand the submarket and they get those projects through. So I think we see a lot of that rather than they've got projects in 5 counties. They're focused in Albany, or they're focused in Albany County, or wherever they seem to have success.
So staying with the theme of government, this is my magic wand question. If you oversaw New York State government, what changes would you immediately make to the regulatory framework? And now keep in mind, you need to protect the environment and the interests of many different citizens while also enabling new development and growth. Go ahead. Go ahead, Jesse.
Well, I think it would be to get those in government to understand that when you come up with a brilliant idea, it would be better if you got some input on how that would affect everybody and hear both sides of the story. I think there's no question that there are residents and tenants who fulfill their obligations and those that don't. And there are real estate investors and operators who fulfill their obligations and those that don't. And you're always going to have that. And a lot of the laws are written against those who don't. So it's the hardest when things keep changing. We have a project right now. It's like we have to get the building permit applied for by January 1st. Otherwise, everything we've done up to this point now needs to change because the code's going to change again. Mm-hmm. That makes a project very difficult. But understanding, I think we would all be a lot better if there's an understanding. Yes, you're trying to protect something or somebody. Every law is. And it's not that those things shouldn't be protected. It's not like stormwater is not important. But what is the real effect of what you're doing, and how do you then go and execute it? It's just not efficient to say with the storm regulations. What I've heard is there's 5 guys who are just going to spend their time deciding if projects impact wetlands or not. That's not very efficient, especially if you're doing it from aerial photos where a stone wall looks like a stream and you've got the wrong information. So how can we keep taking the good ideas but understand the net effects of them from both sides?
Okay. Who else would like to wield the magic wand?
Jesse's looking at it very pragmatically, but if we're at the wave the magic wand stage, the governor has said that we have a housing crisis. So if folks in this room agree that it's a true crisis, do you do things the same way during a crisis versus not during a crisis? So if this is a crisis, I think the state, should consider what I would say, allow municipalities to create some zones or some areas where a lot of these regulations could be grandfathered. There could be a very generous density and also very generous pilot agreements. And I think that could create quickly a large magnitude of units. And when you have residential, retail follows. And I would do them, in areas that had adjacencies to other amenities that a city, may offer. I think, we need to think out of the box in some fashion. So hopefully the state, we have another legislative session coming up. Hopefully it would be policy designed to increase inventory, not to suppress it. One bright spot that we have seen over and over again is the historical tax credit, which is a credit that you're allowed to take. It's to rehabilitate dilapidated buildings across the country. The U.S. spends like $25 billion a year on these credits, and the economic benefits is in the hundreds of millions. And restoring the character, to these cities, and most of the time it's done to create more units. And if you could take a successful program like that and expand it, maybe the criteria shouldn't just be historical buildings. Where there's a housing crisis, maybe if you included new construction as well, that 20 and 20 really makes these projects feasible. So that's another wave the magic wand, suggestion we would make.
Brian and Jessica, here's your chance.
I guess for me on the financing side, I would probably like to see with the pilot program that there were longer pilot programs. They're very important for new construction. I mean, it almost makes the projects they're only viable, a lot of these, with these pilot programs just based on economics. A lot of the ones we see are 10 years, and it escalates pretty quickly in the last 5. And so you almost get back to a point where you started from, right? Like you need those to get it under the ground. It helps those first 5 years, but then you now have a different asset as those taxes start to really, especially in our market, obviously everybody knows what you're paying on the tax bills that we see that are just hundreds of thousands of dollars. And I understand the revenue is very critical, but to Steve's point, multifamily does drive a lot of these other industries, right? It's the core of what we have here. It's the most important piece. So it can't just be about that asset. It should really be about the viability. So if you could extend those to 15 years or something like that, I think you would, we were talking, it's a long play. I think you would provide the opportunity for more sustainable and more driven sales when the time comes when these things come up.
Okay, Jessica?
Well, I think all of the ideas that they expressed are great, and the bonus density typically is something that could really be helpful, especially with the new DEC rules, because you have less land you can build on now. But my goal would be to have a process where you can get a project done in a reasonable amount of time through the municipality and make affordable housing affordable to build.
So a lot has been made of the City of Albany's inclusionary zoning ordinance, which was 2 years ago. It was made even stricter, as essentially a percentage of new market rate units in a new development have to have a rent that's affordable up to a certain median income. And the consensus is that this has really killed the appetite for new construction, market rate in downtown Albany. Do you think it would make, or how big of a difference do you think it would make if we went back to the initial version of inclusionary zoning that was on the books since 2018?
Yeah, I think it's super critical because it went from 5% to like 13.
And just explain that, Brian, when you say that.
Say you had 100 units, you'd have to have 5% of those units at a market rate number. That's probably digestible on a project. When you get to 13, the only way to make up that income is to charge higher rents for your other tenants, right? You're going to have to subsidize that, if that makes sense. So I feel like the drought you're seeing right now is very much heavily weighted on this, because the 5 to 13% number, 5 is digestible, 13 I think skews the numbers to a point that they can't. It's very difficult to make that make sense.
Jesse?
I think that's a major issue, but I think there are also other problems going on in Albany. It's become much more difficult to operate in the city of Albany, from requiring ROPs every 30 months, which they've sort of always done. Now you've got a building department that's being much more forceful and aggressive at saying you need permits for everything under the sun that in the past repairs, not so much. You've got courts that are backed up, so when you have a bad tenant, you can't evict them. You have good cause eviction going into place, which caps how much your rent increases are, although I don't think that's come into being. The hitting the cap hasn't happened yet, but my prediction is, over the next couple of years, everybody's going to be at the cap, because once that year passes, you can't go back. So you're going to see rents actually increase faster because of that, in my opinion. And then all of the other stuff that Brian just talked about to build new. It's very difficult taking an old historic building and turning it into a new apartment. There's oftentimes structural things that you can't overcome. You can't make stairwells wider. It's hard to get to a modern standard. And you've seen it fail over and over and over. When I first came to the area, they were doing the project on Clinton Avenue. They were rehabbing 200-300 buildings. And that project has suffered for the last 30 years. I think it's gone bankrupt twice, restoring all of those buildings. And, it also goes back to what you were saying about the quality of the housing and the growth of the housing stock. Albany still struggles with vacant buildings. Schenectady struggles with vacant buildings. Troy has struggled with vacant buildings, but is starting to get better. All of the infrastructure, all of the things we need to build out in a field in Brunswick already exist in the city of Albany. They don't have to add more police. They don't have to add more schools. They're having a problem that way, but they make it so hard to deal in the city. I think that's also hurting them.
Steve, BBL's, go ahead.
Yeah, that Clinton that was our project.
Oh, sorry.
Yeah,
You built it. You didn't own it.
but yeah, I think all of these.
That's the difference between the builder and the property manager. They only had to deal on the front end, not afterwards.
All these laws and regulations have the unintended consequence of reducing inventory. And now I think there's an acknowledgement that, we do have a housing crisis and we need more inventory. So hopefully there will be a change. Vibrant communities, really don't have suppressive regulations on the books. And in the capital region, if you look around, we have wonderful communities that are just doing great. I think we need to address our urban cores. Our urban cores are disproportionately, suffering from poverty. And I think, as a region, if we're going to thrive, we have to attend to that. And I think it starts in the neighborhoods and with the education system. There is an inequality of opportunities if you don't have a high school diploma and you don't have a skilled trade. So I think that they're a bigger issue for another panel, but I think, one regulation in the city of Albany, I think the problem is much deeper. And Albany is not alone. It's very common through urban cores, throughout the nation.
Thanks, Steve. Jessica?
I think Albany has a lot of interesting challenges ahead. You've got downtown, which after 5 o'clock, everybody leaves. You've got a lot of empty office space there. You've got the whole St. Rose thing going on. So there's a lot of dichotomy in Albany that needs to be figured out.
Well, given the high costs of construction and financing, why does it still make sense to build on a greenfield in the suburbs versus in a city that already has water, sewer, and other infrastructure?
Well, I can only go by a couple of, real life situations. We've done deals where people have bought in the city, right? You're taking down the buildings. You pay X amount for that real estate. It's not dirt, right? It's an old set of buildings. There's that inherent cost, and then 9 times out of 10, they're going to make you redo the infrastructure or add to it to a level. So, a bare piece of land wasn't a gas station 100 years ago. You don't have to worry about the environmental pieces, whatever, all those things. I do think there's viability in both options, but I do think a clean slate seems to work really well. But I do have borrowers that have gone the other route, just inherent costs that they work into their budget.
Thanks. Jesse?
We've done both, and it's much more predictable on a greenfield. You know what you're building, you can draw it all out. When we redid Draper School, which is 111 apartments, you didn't know what you were going to hit, and you didn't know when you were going to hit it. One interesting piece, there's the front of the building is about 200 foot long. It's a wood frame building. The architect spec'd out, put the doorway here. They cut it out and they hit a steel beam. One steel beam for 200. Why is there a steel beam here? We ended up having to move the door. Worked out that it was supporting a new roof they had put on and went to the basement. But you don't know that going in, and you run into a lot of those unknowns. So it's much harder to budget, much harder to determine time frames. There's too much. There's a lot of unknowns that you're dealing with, along with the environmental stuff. Are the water pipes lead paint? Is the existing storm sewer or sewer system a combination sewer? We have one project that's like that. So if we redo it, we're going to have to separate it, which is a good thing. But that's the same. Not only do I have to put in the new infrastructure, I got to take out the old infrastructure. So you're not ahead.
Steve, can you think of a recent urban project BBL did where you hit with some unexpected, unforeseen?
Oh, yeah. I'm just thinking now, we call it, it's a big mystery, when you get into the urban areas and, the Renaissance, 144 State Street. Unexpectedly, we spent $5 million on infrastructure, underneath the sidewalks out on State Street. And it was nobody's fault. It just needed to be replaced. I think it was there since the 1920s. And so you want to have projects where your residents have convenience. And the city should have an advantage because, they should have the schools and the restaurants and the hotels. But when that becomes inconvenient, to live in the city, that's where you're going to get the favorability of the suburbs.
Again, if there are any questions, I think we just have about 10 minutes left. There's a gentleman over here.
Hi, good morning. Peter Gray with Jesse, you briefly mentioned the change in code coming up at the first of the year, which is forcing you to change your infrastructures going into buildings. That utility cost is obviously a burden for renters. And by going to one energy source, it makes the future cost that much more unpredictable for those tenants. Do you figure that into the cost or planning of a project?
I think the change to electric only is going to be difficult in that I don't think we make enough power, and I don't think the facilities to bring the power to the site are going to be sufficient to what the actual draw of that project is. Building a project that's designed for the electric heat in the energy code and how it's designed and all that, I think is much less of an issue. And that the utility bill is going to be the utility bill. We have some properties that were built in the 1940s that there is no insulation, and their utility bills are much higher. Does it have an impact on the rent? Yeah, a little bit, but I find residents to be kind of flexible on that. Where I think it's going to become a bigger issue is on existing properties where you have to try and retrofit to now, if they're actually going to phase gas out. Sounds great, no more gas stoves, but if I have gas stoves in the property, I may not have enough electric into that unit to support an electric stove. So I can't just swap it out. Now I might have to upgrade the service to get there. I might have to upgrade interior wiring, and if I need to put a stove in, I got to put in a new 220 line just for the stove, regardless. And if there's no room in the breaker box and there's not enough power, now it just keeps multiplying. So I'm much more worried on the retrofit side than the new construction.
But just to clarify on that, that mandate does not in any way touch existing buildings?
Not yet.
It's all new
Not-
construction?
Not yet.
Okay.
And that's, where the problem comes from. There's federal guidelines on phasing stuff out that are aligned with my understanding. I'm not an expert in this. I usually leave this to the construction guys. But it's aligned with the useful lives of systems. So it's one thing to get the whole useful life out of my system, and now I have to replace it. I'm going to just replace it to the new spec. It's a completely different situation when I get half the useful life, and now I have to replace it. And I think that part makes a big difference. And how the property is designed. We have apartments in Half Moon. That's 4 units, so not a huge place. 1 furnace, heats them all. We provide heat. Said, okay, can we go to the split duct units, change this over to electric, and have the residents pay that cost? Well, the new boiler was $9,000, and the split ducts for every unit was $25,000 per unit, because the units aren't designed for split duct systems. You have to put one in every single room, and it just doesn't work.
Okay.
And that's where I think in the future we start to run into problems.
Was there another hand? Yes, in the back.
Hi, Louise Giuliano, Brokers Network, Commercial Division. I have a personal issue. I have a couple of modest investors looking for multifamilies. It's hard to find anything within their, $1 to $2 million budget. So I would like to ask you, we've been to a couple of places like office properties that they're thinking of possibly, converting them into multifamilies. Can you address that feasibility? And if I noticed, I went into one office property for another client, and the upstairs had all been converted into apartments.
Thank you.
And so if you could address that for a moment.
Yeah, I think it depends on the box. You need a good box, and you need windows. Those are the two components. Now, you need all the other fundamentals, like location and, and a budget and a pro forma. But, a large commercial office with a lot of interior space is not going to be convertible. So, a lot of schools, old schools lend themselves that way. Some smaller office buildings, I think they're really struggling in New York City right now because the floor plates are just, too big. But, those are the two things I would look at, are the windows and the box to get started with. What are your thoughts, Jesse?
I would agree, and those projects can be a lot of fun. You got to have some vision to be able to see through the walls and really picture what can be there. There's some beautiful old office buildings. The architecture that you can capture. We did 2 schools. The Draper School in specific had the gym floor was still in excellent shape, and we were able to preserve that. And in those apartments, the gym floor is the floor of the apartment, so you've got the baseline running through your living room. It's kind of cool. So you can end up with some real cool, funky, interesting designs, and not your just standard cookie cutter apartment. But again, they come with their difficulties, like any project.
We have one project that I'm aware of that over in Troy that was an office conversion, and it's going really well. It was well located, good parking. The other ancillary stuff was very critical to it, and that was a 4 or 5-story building that converted into apartments. That was office, and it wasn't really usable office anymore either. So the conversion to the apartment thing was what made a ton of sense in that capacity.
Great. Heather, was there another question?
I also wanted to say that if people had questions for you, we can include him too. I can bring him the mic. So if you had economy questions or panel questions, we can include that.
Oh, yep.
With the new all-electric affordable housing,
And could you just wait for the microphone, please?
I'm pretty loud.
I was not going to say that, Ann.
With the new affordable housing buildings that are going up and they're all electric, what are they going to do when the power goes out?
Well, if they were really smart, they at least put in a generator to support the life safety systems and the elevators. So it's going to be difficult. You know, part of what we do, I mean, we don't have that situation yet per se, but we do have power outages, and because the weather's getting a little more ferocious, you know, that power can be out for much longer than it used to be. So, you know, we have disaster plans for each of our property to be able to last for more than an hour or two. You know, when those emergency lights might last for 5-6 hours, and if you have an internal hallway with no windows, it is then pitch black there, and you need to, you know, have some plan for how you're going to deal with that. Luckily, most people carry cell phones that have a flashlight in them now, so that mitigates it a little bit. But that's one of the areas we're really worried about. There's a lack of resiliency in what's being proposed, which sort of brings me back to you. Hey, whatever regulations you're creating, that's fine, but understand all of the aspects of it.
So Michael, I just wanted to say, Louise, your question about finding affordable buildings where you can do multifamily, there's quite a few smaller buildings available where you can do commercial on the first floor, and they can do apartments above. And it's just a matter really of making it pencil out. But those opportunities are there. You don't have to buy a 30,000 square foot office building to make it happen.
Yeah, we have 2 under construction right now. One in Utica, commercial office, you know, built in the 1930s, I believe. And the other one, Barnett Mills, which was a factory in Rensselaer built at the turn of the century as well. And again, that historic tax credit program comes into play. And if you think about it, some of these buildings that were built in the 1960s may qualify. You know, believe it or not, that was 60 years ago. So, yeah, I would definitely look into that.
Was there another question, another hand up?
Any other questions? You could also ask questions about the economy, too. We're opening that up, too, if you have questions for Hugh at this time. Yes.
Thank you, panel. My question is on the urban development and the lack of food scarcity and food markets down into like the Albany area. If you do bring the multifamily developments in there, have you guys found what's going on in terms of support for food, tenants buying actual food? Thank you.
That's a tough question. The traditional methodology or thought process, you know, is apartments lead, retail follows. And until you get a big enough critical mass, they're not going to follow. And when you think about specifically food, your neighborhood grocery store doesn't really exist anymore as such. You know, Price Chopper, Market 32, Hannaford, those are all pretty big boxes to be efficient in their world and their thin margins. And I think you see some changes that are happening to start to provide that with what like Cumberland Farms and Alltown and Stewart's has done, that it's not just I can get a candy bar and a soda, but there's quite a bit of food in a lot of those stores. And I think that's how it's going to continue to evolve if someplace like the city of Albany is going to let, you know, a Stewart's or a Cumberland Farms build a big enough location to have that. If you look on Union Street in Schenectady, Upper Union Street has the little Stewart's with the 2 gas pumps, and 4 or 5 blocks down the road at McClellan, they've now got this huge store. So I think that's where it's going to, that's how that problem is going to start to resolve.
And I would just add,
Yeah, it's a serious problem.
Yeah.
You know, when you have to use public transportation to go grocery shopping, it's just very expensive and very inefficient. And it's a big burden, too.
Sure. I was just going to add, there is that example of Bargain Grocery on River Street in Troy. I think, you know, that's very much their model. Felton, you have a question?
Yeah, hi. Can you all speak to the impact of the new DEC wetlands regulation that's expanded the definition of wetlands? In case you're unaware, the State Association of Realtors has joined a lawsuit to try to overturn that. And, you know, any horror stories we can pass along sort of help buttress the case. But that new expansion of of wetlands. You know, you go from the 50-foot barrier from a floodplain to 100 feet. Just hoping to hear what you guys have experienced.
Thank you, Felton.
I'll let you take that one.
Yeah, this is going to be a two-part. You're going to follow up here. But yeah, it is very restrictive. And, you know, we've had very successful projects that under the new standards just wouldn't get built. And the irony of it is those projects we did actually came with additional wetlands. And at the conclusion, the community had more wetlands than what they started with. So I don't know if it was, you know, very well thought out in terms of looking at, you know, all of the constituents involved. Now, DEC can issue permits, and that's been, you know, that's going to be the case going forward, where traditionally you got it through the Army Corps, and you relied on the Army Corps maps or DEC maps. Now, going forward, you know, you're going to have to map every project that you go into. And it's more than 100 feet. You know, if there's certain habitat involved, it's 400 feet, right? So it's going to be, there's going to be a lot of projects that just are not going to be, you know, able to go forward unless you get a DEC permit. Some people have, some proponents have said it may force future projects into more urban areas, you know, redeveloping, you know, existing, you know, so that could be a positive. But this is just another regulation that reduces inventory and drives costs and has unintended consequences.
And I think there's a couple parts to the wetlands. There's the new law and all of its impact and dealing with that. But I think it's also important to remember that wetlands and stormwater management is really important and really a serious issue that needs to be addressed. You know, when you look at flooding we had during Hurricane Irene, or, you know, any of the flooding around, that's infrastructure and communities that were not either built or maintained with enough thought about stormwater management. Hurricane Irene in 2011, our project Long Pond was ended up being evacuated for 3 days. Literally, we had 4 buildings that flooded. And when we tried to figure out what happened, there was literally 5 different stormwater points of failure around the property that caused that situation to be created. So it's not only making sure you're building the right stormwater infrastructure, but maintaining it. And as I'm sure everybody has seen, you know, you've got that storm drain that gets covered with leaves, and nobody cleaned it off, and we get a big flood. You know, that's going to be a problem, you know, just on its own. And, you know, we are getting many more storms that are that torrential downpour, you know, 1.5 inches in 10 minutes, it seems like. And most of our stuff is not designed to take that volume of water at that time. You know, we manage Adams Park down in the city of Albany, and I remember probably 25 years ago, that property still has a combination stormwater sanitary sewer, and this hurricane came through. It literally blew the manhole covers off the street, and we had water coming back up through the downspouts and geysering out 2 stories in the air. There was so much back pressure in that system. So it's not just about the new regulations, but, you know, how do we maintain and enhance what's around, and how do we think about our environment in total? We're cutting down a lot more trees these days because the storms are more ferocious, and I'm tired of buying, you know, new roofs. Because the tree, you know, this tree that looked fine, but, you know, was too big and you know, came down through a roof. So I think all of those environmental issues we need to look at. As I don't think the new regulations are good or helpful to affordability and all the other things, but it's still an important topic that we need regulations that are appropriate.
So we've just got a couple minutes left, and this is a question that probably does not have a short answer, or maybe it does. How are advances in technology impacting you in business, and specifically, to what extent are you already using AI in your industry to help with decision making?
So I can answer that really quickly. AI reminds me a lot of when texting first came out. Remember when texting first came out and everybody was like, I'm not going to do that. What do I need that for? Right? We have email, and so many people fought texting. Well, how many people in this room text like every 5 minutes, right? It's the same thing with AI. You have to learn it, you have to embrace it, and you have to use it to help you be more productive. But there's a caveat there. You have to be careful, because you have to make sure the information you get from AI is accurate. And the problem that I see in my industry is some people use AI and they don't use it effectively because the information they're getting is not accurate. So that's my warning to people. Learn about it, use it, but be careful and make sure what you put out there is the right information.
Great advice.
Yeah, well, on the construction side, there's a long history. Advances in technology have made us more productive, and that's what we're looking to AI for. It really hasn't not been largely incorporated into the field. We have a lot of technology in the field. We have recently, we have AI embedded in our project management software system and in our accounting systems. We're going to be having a conversion next year. It's going to enhance that. But I would agree with Jessica. Just be careful. We're in the early stages now, but we're always an optimist. New technologies have always created more opportunity, and hopefully this will as well.
Jesse, Brian, you got 30 seconds.
30 seconds. AI is a tool, not an end. And I think you need to think about carefully how it can benefit you the same way cloud computing benefited people and any new technology. So it's a tool.
Okay. Brian?
And we basically have adopted some of it for some efficiencies and maybe some more global views on things to kind of quickly get back. But I still think at the end of the day, it's still people, it's still, you need the intellectual acumen of the individuals in submarkets to understand this is the wrong corner. I don't care what the numbers say. You can't. Nothing works here. So we are looking forward to kind of hopefully streamline some of our processes and kind of get through things a little bit quicker. But we don't see it as a end-all, be-all to decision making.
So there's a reason for hope for the human race. That's good to know. Before I turn it back to Jesse for closing remarks, let's please give the panel a big round of applause.
So thank you, Mike, and thanks to our other panelists, Steve, Jessica, and Brian, for sharing your perspectives this morning. And also a big thank you to Hugh Johnson for starting the day with such a thoughtful look at the economy and what it means for our industry. So thank you, Hugh. As we end today's program, I'd like to acknowledge that what gathering like this makes possible. Together, we've strengthened our industry connections while also supporting the regional food bank work to fight hunger across eastern New York. We're fortunate to be joined by Joan Dwyer today. When Sunrise expanded the Enjoy One, Share One program from the Century House to our employees, it helped them understand its impact, that for every home base we provide, whether it's an apartment stay or a hotel stay, Sunrise sponsors a meal at the regional food bank. It was an important moment for our team to see how work that we do every day directly supports families across our region. Joan Dwyer serves as the Executive Vice President of Strategy and Business Development for the Regional Food Bank. She's been with the organization since 1996, leading the effort to build strong partnerships with food industry and business community, ensuring that every neighbor in need has access to food and support. So, Joan, could you please come up to the podium and give a couple words on the food bank?
Thank you, everyone. Just cannot thank Jesse and Heather and all of the Sunrise team enough for everything that you do to support us throughout the year and for raising awareness through events like this. It's been inspiring to hear the work that all of you in this room are a part of doing to build hope for housing, a basic need. You know, the food bank is nourishing hope. So food is a basic need, just as is housing, and we need the support of everybody in our community to help us do that, whether it's donating funds, donating food, providing your time and expertise. All of that contributes to us being able to expand our services. So we serve, again, 23 counties, so 40% of the geography of the state. We work with the all different parts of the supply chain in the food industry, from growers and manufacturers through to distribution centers and our retail stores, to receive food that's not marketable, but it's still wholesome and viable for people to have to eat. And we just can't thank everybody enough for what you do to support our work. So I have some different pieces here, our newsletter, and thank you to Heather for creating the table tents. They take you to different areas of our website on how you can support in different ways and more information about our work. We have a major Thanksgiving distribution coming up on Saturday, November 22nd. It will be at sites throughout our region, Capital Region, as well as the Hudson Valley, where we have our other distribution center, and also in the North Country. So we began that, taking that over last year from Equinox and built that here in the Capital Region first, and now we're bringing it to all corners of our area, and we very much need support. Our goal was to have 25 sites and 50 senior meal sites as well for prepared meals, in addition to the 25 grocery bag sites. And we just cannot do that without the support of the community. So we encourage everybody to look at our food bank information and support in any way you can. Thank you again to Jesse and Heather for the home base program, and all you do throughout the year to support our work and raise awareness. So thank you.
Thank you, Joan. Now to celebrate this partnership, I'd like to invite Hugh to come back up here, and Heather to bring our donation check. She loves the big check. On behalf of all of us at Sunrise Management and Consulting, I want to thank you for being part of the summit and for helping to strengthen our communities through collaboration and your support of the Regional Food Bank. We're proud to present a donation for $2,825 today to the Regional Food Bank with our Sarah. Get right up front. And thanks again for coming, and hopefully we'll see you next year.
Ready?
Guys, get in the picture.
3, 2, 1. Everybody can get behind it?
Yep.
Perfect. All right, here we go. 3, 2, 1. One more. Great.